Hi everyone, welcome to Portfolio Watch, your stock market guide on what's hot and what is not. I am Fifi Peters. On today's show, we discuss the trends in currency markets and when trading should be approached with a long-term or a short-term investment strategy. In the second half of the show, we examine whether bigger is always better and when do mergers and acquisitions indicate a good time to invest. Remember, you can follow the conversation with us. The hashtag to use is Portfolio Watch. Tweet us at CNBC Africa. Tweet me at Fifi Peters. Right, let us get straight to it. US-China trade tensions have continued to strain global economic growth. Currencies are impacted by higher volatility as all that uncertainty around policy and trade continues. Now, joining us to discuss the impact that Forex could have on your portfolio is Andre Cilliers, Director at TreasuryONE, and James Turp, Head of Fixed Income at Absa Asset Management. Gentlemen, good day and thanks so much for your time. I'm reading that we are coming from one of the worst weeks for emerging market currencies as a result of a whole host of issues. Do break them down for us. What is causing this dent in the rally that we have seen in emerging market currencies so far this year? James?
Thanks, Fifi. Well, it's almost out of the control of the emerging markets at the moment. What's causing a lot of the volatility, it's dollar-based. It's global trade tensions oriented. So difficult as an emerging market to control these, but it's the ramifications it has economically for your market that is why your currency reflects those risks. So it's out of the EM control, but it's generally been US-China trade, US-Europe, US-Japan trade developments this week that has caused a dent in EM.
I mean, Andre, for you, China, and the US and what is going on or what's not going on between those two countries, how big of a dent could they cause in this EM space? Could we become worse than what we were already seeing?
Absolutely, yes, because the trade war between what Donald Trump and the Chinese are doing on the trade war side is going to impact on world growth. Apart from that, there's the tension in the Middle East that Donald Trump is continuously speaking about, the increase in oil prices, the ramifications of that on world growth on the economy side. And that will impact on the emerging market space. It will impact on our economies. It will make things especially difficult for us in South Africa, coming out of really low growth, and we need much higher growth. Just coming out of elections, emphasis on what Cyril is going to do on the stimulating of the economy and so forth. Together with that, all these tensions in the Middle East and Chinese trade war, American trade war, will definitely impact and make our lives extremely difficult and definitely impact. So it could become worse.
I imagine that the impact isn't equal across the EM space. I do understand that the Rand is weathering this difficulty a lot better than some of its peers. So could we just discuss, exactly what is going on with the various currencies right now? Who's topping, who's not? I do understand the peso is like amongst the worst performers so far this year.
So the Rand's done quite well, and it's kind of similar to that Ramaphoria that was experienced after the elective conference. If you remember how strong the Rand became after President Cyril Ramaphosa won at Nasrec, and that actually, if you broke it down, was an emerging market rally. But because there was some positive news within South Africa, the Rand benefited kind of better than other EM currencies.
Right.
And we've got a similar situation right now where emerging market currencies are under pressure. But after our peaceful general election and the kind of optimism that the market's got, you've actually seen the Rand hold on to some of its value there. So it's still trading in a volatile fashion, but it's actually holding up as a result of the idiosyncratic factors that South Africa has. Looking across EM, you've got to differentiate in many respects what is portfolio changes to EM currencies and what is actually as a result of the local economy of that particular country. So that's important to differentiate.
All right. Because quite often when speaking about currencies, we speak about trading currencies. The conversation about investing in currencies is not a popular one. But there is a distinction though, Andre.
Absolutely. One must really distinguish that when one speaks about investment in foreign markets, in other countries outside South Africa, it's got absolutely nothing to do with currency trading. And when one starts evaluating investment into other markets, you should really strip out the weakening or the strengthening of a currency by simply implying or applying a hedged position. In other words, stripping out any currency movement. So your hedging cost would be based on the interest rate differentials between the currency in which you invest and where your money is emanating from. And if you take that cost and strip it out, then you end up with what is the actual growth on your investment in the foreign currency. Currency trading is something completely different. I can trade currencies without actually taking 5 cents out of the country. I can simply invest it in or put it into a margin account on one of these trading platforms that you get, and then start trading. You can buy in the morning, you can sell in the afternoon, and whatever, as many times as you want to. That's got nothing, absolutely nothing to do with investment.
Okay, so let's focus on the portfolio management side. And James, I do understand you've done some research here about the performance that, or the money that investing in the various currencies in the EM space have given investors over time. Walk us through those.
Yeah. So it's an important point firstly that Andre makes. Of course, you should always look at investment from a hedged position. So we always advise our investors to hedge currency exposure. We'll always see companies report on a currency neutral basis. So that's step one. When we talk about portfolio management, we look at currency position as a hedge. We'll look at the correlation between that currency and other asset classes within a multi-asset portfolio. That's important to also look at. And then you boil down to the local yield of that asset on a currency hedged basis or on a currency exposed basis. But you've got to start off with the interest rate differentials, as Andre says. Then you can boil down to actual countries, and you can look at, as that chart shows, how the different emerging market currencies has behaved. But what you would also need to do is look at what you would have got from growth and from inflation in those countries. So on the chart you can see Argentina, Turkey performing poorly over the 3 and 5 year areas, whereas the rand actually holds up. It loses over 5 years around 38%, but if you broke it down and looked at what you could have got in yield terms over 5 years, for instance in government bonds, you would have got an average of around 8.5% per year for those 5 years. So then you need to do your research on what growth is, what inflation is in those countries, try and strip that out, and then work out whether it makes sense as an investment and what the correlation benefits are against perhaps the other asset classes in your portfolio. So it's a really complex decision.
Very complex. I mean, we were just looking at the Turkish lira in that graph. We know the country's in a recession. The lira looks down some 14% or so. But Andre, in terms of your portfolio management with these currencies, where are you putting your money and where are you not?
Okay. First of all, when one speaks about portfolio management, then I immediately have to say that foreign investment is only a part of your portfolio. I think it's irresponsible to take all your money and put it into one area.
Sure.
As we speak about investing your money, you speak about investing it across different asset classes. So foreign investment would form part of your investment portfolio. And once again, when you look at your foreign investment portfolio, you would also try and invest that into different asset classes.
Right.
Once
so
again, you're not going to put it into one asset class. So you would split up, first of all, from a starting point, you would split up your portfolio into what do I want? What exposure do I want in foreign currencies, and what exposure do I want in my local currency? That would depend on where do I stand in my life cycles, how much money is it that I'm investing, how soon do I need the money. There's various things that needs to be taken into account.
Okay, so but for those who are asking now the question in terms of where to put your money in foreign currencies, I mean, we've discussed a bit about what the Turkish lira has done and also the peso. What would you advise?
if it was my personal money, then I would put sort of the bulk of my money not really into emerging markets. I would put it into into the US markets, and I would then look at most probably putting money into Australia. I would put some of my money into the UK, so more of a balanced approach across markets. And of my foreign portfolio, I would only put 30 to 40% into emerging markets. And then I would look at into the space of China, India, I would almost say more into the BRICS area.
The BRICS area. And for you?
So I think the way you should look at it is, firstly, what are you mostly exposed to? As a South African, well, you're mostly exposed to the rand, of course, because your earnings are in rand and your asset base is in rand. So effectively, you're fully exposed to EM volatility. So what you'd like to do, as Andre says, is look for perhaps some first world currencies such as dollar, euro, and perhaps the sterling.
Right.
Try and work out a strategy around those. Is Brexit going to make the pound volatile? Is European growth looking good, which it supposedly will do? So perhaps getting some of those major currencies in your portfolio, and then perhaps if you want to take some EM risk, appreciating that you're fully exposed, you perhaps want to take very selective calls on some of those economies. But personally, you've also got to look at timing in the market as well. It can't be a speculative call. It can't be, I want currency from now till the end of the year. It's almost got to be a building block within your portfolio, because if you go back 3 years, dollar rand was at 16. If you'd invested now, you'd have lost money. Over 5 years, dollar rand was at 10, so you'd be in the money. The reality is, as a portfolio philosophical view, you've got to be consistent. Build a currency portion in, understanding that it's there to hedge the rest of the assets in your portfolio. So that's the kind of way we look at it.
Final words?
I think James has mentioned something really important. When you speak about investment, firstly, there is no such thing as investment for 12 months. That's a savings account. That's a fixed deposit. I need the money quick and I want some growth on it. Investment is a 3-year plus period.
Sure.
And then there's the factors that you need to take into account that is mentioned.
Sure. Well, thanks so much for those insights, gentlemen. We're going to have to leave it there. Of course, I was in conversation with Andre Cilliers, who's the director at TreasuryONE, and James Turp, head of fixed income at Absa Asset Management. Let us go to a short break. When we return, we examine how mergers and acquisitions offer opportunities to make profits in your portfolio. Do stay with us. Welcome back. Now, there's been a big drop in mergers and acquisitions in South Africa in recent years. In 2018, M&A activity totaled $4.3 billion, and that was down from $7.5 billion in 2017. That's according to data from Global Transactions Forecast. Now, the drop in mergers and acquisition was blamed on slow economic growth, on political uncertainty, and also risk-off sentiment towards emerging markets. But it is expected that this year we could see a rebound in deals, and joining us to discuss more of this and exactly which mergers and acquisitions you should be keeping a close eye on is Gary Booysen, Director and Portfolio Manager at Rand Swiss. Gary, always a pleasure. So 2019 seen as the year where we see an uptick in M&A activity. Right now there's quite a few deals on the table. Let's start in the mining sector, where Sibanye-Stillwater is wanting Lonmin. That deal is expected to create the world's second largest platinum miner. What do you make about that, or what do you make of that transaction?
So interesting transaction. It's been going on for a long time as well. So it started in 2017, and you know we had pegged the Sibanye as the potential acquirer of Lonmin's entire share capital, even before that, because you know post Marikana, looking at the I suppose the labour relations, looking at the huge cash burn that Lonmin had, it was a company that needed a big brother kind of partner to come in and recapitalize and change the business. It was either going to be someone like Sibanye, or it was going to be potentially a Chinese consortium of some kind. That was the other kind of front running idea at the time. What happened after that is we obviously obviously saw Sibanye make the offer. We've seen, various negotiations around it. We've seen AMCU trying to block the deal recently. And it looks like it's going to go through. Sibanye has essentially offered an all scrip deal, so it's a share deal, a total share deal, where Lonmin shareholders will get one Sibanye share in exchange for their one Lonmin share. Now, if you look at Lonmin as a business, as we said, a huge amount of cash being burnt at the company, just with the way that it's structured. But there has always been a very strong argument that the actual assets inside Lonmin are worth far more than the market capitalization of the company. So that was one of the reasons that we had pegged Lonmin for a takeover target, even pre-2017. What happened was, essentially the concentrator that's inside there's huge synergies, especially with Sibanye, that can take over that concentrator. And unfortunately, you look at Sibanye's share price today. I think Lonmin shareholders are getting a raw deal, but we always kind of assumed that they would, because if you look at the rights issues that went through the company over and over, like deeply discounted rights issues, a huge dilution had gone through, and I think the shareholder base of Lonmin was just so tired of it that if you actually looked at like a DCF model on Lonmin, and the shares were valued at kind of 35 Rand a share, there was no one that was willing to come in at that price, and we always knew the acquirer was going to get a fantastic deal, which I think Sibanye has done. I think Neil Froneman's made another fantastic acquisition, and this could potentially create the world's second largest platinum mine.
Yeah, Sibanye coming out with a statement saying that speculation that they would up their offer for Lonmin is not true, and that the offer currently on the table is as it stands. Those shareholders voting May the 28th on that deal. Let's move over to the food space, whereby another big transaction is in the pipeline, Milko taking over Clover. What do you make of that transaction?
So I think it was a fair transaction at a fair price, and it really depends on what's going to happen with South Africa going forward. Whether it turns out who the winners and losers are going to be. I think part of the rationale behind the transaction was the transaction is a Tel Aviv-based company is through a consortium called Milko, is going to buy out again the entire issued share capital of Clover. They're going to delist the company in Namibia and South Africa, and in South Africa it'll be at 25 Rand a share. So generally, when you see these kind of corporate actions on a stock, you'll see the stock immediately ramp up to a small discount to where the deal is expected to go through. Now, in that discount is the carry cost, so essentially the interest that you would pay if you borrowed money to go and acquire shares, plus the risk premium. Those are the two factors in how deep a discount to the deal price is. So at the moment you've got Clover trading 22.5, 23. So there's some small risk premium that the deal might fall apart, but there's also obviously still some way to go to get it through the competition authorities, etc.
Yeah, of course it's also suffered a bit of a delay following the pullout of Brimstone due to pressure from their lobby groups.
Exactly right. Now obviously because this is a Tel Aviv-based company, Brimstone obviously very prevalent in the Islamic community. There has been pro-Palestinian activists that have put pressure on Brimstone and Brimstone is essentially the BE consortium partner.
Yeah.
So they currently have had to step back. I think they tried to put the deal through because I think it is attractive. I think Clover is an attractive business, and it would be nice to have a stake in it. At the moment, they're sitting in a position where they need to now find a replacement consortium, a replacement BE partner for the company, and then hopefully the transaction will go through. It does look like the transaction will go through. It's just slightly delayed. But remember, this share price has ramped up from mid 13 Rand a share post the announcement. So should this deal collapse in its entirety, I think you're going to see a lot of selling in Clover shares, a lot of quick selling.
Currently up 7% so far this year. As that deal price unwinds. All right, Naspers unfortunately got blocked by the Competition Commission in its bid to buy We Buy Cars. Your thoughts there?
It's a very strange one for me. So the rationale from the Competition Commission behind blocking the acquisition by Naspers was that there's no horizontal competition. So Naspers, via its e-commerce businesses, doesn't compete directly with We Buy Cars, but there was potentially a deal where they were going to bring in Frontier Car Group into South Africa as a competitor. Now, what happened was that obviously the deal got blocked. Now, the reason the Competition Commission gave was that there was also a vertical integration, and it would essentially increase the barriers to entry. If you think about how does We Buy Cars go and source clients and customers, they use platforms like OLX, they use platforms like AutoTrader,
which Naspers owns.
Both of which are owned by Naspers. Yeah. Now, what they're saying is that if Naspers also owns also owns We Buy Cars, they will be able to exclude any other competitors, because other competitors, they can essentially not show competitor advertising on these platforms, and it would give them a stronger foothold in that market. So it seems like a reasonable decision, but at the same time, this seems like the Competition Commission to me fighting against technological progress, because Naspers can still bring in Frontier Car Group and can still block advertising on 2 major platforms if it so chooses. It can still do that. It's their technology that's allowing them to do that. And just by blocking this transaction isn't going to prevent Naspers in any way. I think taking advantage of that that dominant market position.
Another deal that South African authorities look like they're wanting to block, the deal from British American Tobacco wanting to buy Twisp. But the rationale is British American Tobacco is so big that it doesn't really need to buy Twisp to really compete competitively in the e-cigarette market here in South Africa. I mean, why are they taking that move?
It's a very strange decision from my point of view, or from the Competition Commission, again, because as you say, these are global players. One of the reasons behind blocking the deal was that it would lead to less innovation and R&D in the space, if I look at that, that doesn't make sense to me, because this is a global battlefield. If you look at what's happening inside Philip Morris, you look at Marlboro's just spent, I think it's $1.5 billion on R&D for new e-cigarette technology. This is a global battle. So preventing British American Tobacco coming to our local market through an acquisition rather than coming and setting up new operations on the ground isn't, I don't think, going to change British American Tobacco's spend at all.
No.
What it might do, however, is that a company like Twisp, which sits in Cape Town, has manufacturing facilities in Cape Town. Whenever you start a business, you start a private enterprise and you go out to the market and you try and grow a business. One of the ideas is, how am I going to exit eventually? Am I going to list the business, to basically realize the benefit of all the work that I've put in? One of those ways is to be acquired by a bigger company. You see it in tech startups overseas all the time. They go and start an innovative new website, they develop an app with the hope that someone like Google will come and buy them out. It's one of the ability for a large company to buy a small player is one of the fundamental drivers of innovation. So to not allow Twist to be bought out by big brother British American Tobacco seems to me that it's going to stifle innovation more than anything else. So again, an interesting decision, but it does look like it has been blocked.
Yeah, I mean, Gary, of these major deals that we've discussed, which ones are most juicy to you? Which ones would you say, okay, make sure you bag them now, because when it goes through, you could see better profits for your investment?
So, it's a difficult question, because there's lots of different ways that I suppose clients can play these different acquisitions. So one way, you essentially need to take a view on what's going to happen on the transaction. So as the deal was announced on Clover, initially when Clover was still well below that 25 Rand share price, if you're a trader, if you see the deal quick enough, if you have a strong view that this is a deal that will go through and you're willing to adopt the risk premium, then you can go into something, but you need to be early. If you look at Clover now with a small discount, for me it seems like a larger risk. We've got some trouble at the consortium. It looks like it's going to go through, but as I said, there's probably more risk to the downside in that one. For example, we did a separate transaction on one of our offshore portfolios with Monsanto. When Monsanto was being bought out, there was about a 35% discount to where the deal was going to go through, and the deal was expected to go through in 6 months. We looked at the terms and conditions of the deal. We thought, there's a risk premium in this, certainly, but it's a risk premium that's mispriced. So that's where we want to go in. We went in, the deal closed, we made 28% in dollars in a matter of 6 months. That's how you take advantage of these deals. I don't see that in Clover. With Lonman, if the Lonman transaction, and it does look like the Lonman transaction will go through, currently what you've got there is potentially an arbitrage, because you've got a 1-for-1 deal between Lonman and swapping scrip at Lonman for scrip at Sibanye. Because it's a 1-for-1 deal, the share prices should be trading almost at parity now. So you'll see Lonman has been very volatile up into the announcement, and now it should be pegged around the same price as Sibanye. Both are trading around 11.50 at the moment. There's some small discrepancy with that that's generally related to transaction costs and illiquidities in the markets. But if you're a short-term trader, if those prices push out, you could potentially do the arb where you go short the one, long the other, and wait for the prices to move back in line. But again, you're running the risk that if the deal gets pulled, you could see serious volatility on it and find yourself offside. Again, I think out of that transaction, Sibanye is the winner, so I would probably be holding Sibanye stock. But again, you look at British American Tobacco, not going to move the needle. Naspers, not going to move the needle.
Okay. Thank you for that analysis, Gary Booysen. Always a pleasure having you in a studio, and that is where we leave it for this week's Portfolio Watch. Thank you so much for watching. See you again next time.